Hello everyone and thanks for joining me in Fundamental Signals. Amazon recently jumped from $199 to $260. So $60, around 30% move, basically. Around 30% move. Now, the question is, have we missed this rally or the rally going to continue? In this video, I want to answer that question through the lens of P/S ratio against the 2-year average. Okay, so what we can see generally in Amazon over like last 25 years, 26 years, is that the dips in price when the price is at lowest happen when this P/S ratio against the 2 years average is below -1 standard deviation. And it's clearly, you can see that in this chart, whenever we are back down here is when the price is going down. Now, again, if you start buying it here, right, you might still go down further. When you're in the green zone, doesn't mean that's the bottom. It means stock is undervalued and market hasn't noticed it, right? It's undervalued. But whenever this indicator come back up, usually that's when people, like, money start flowing and then the price goes up, like right here, right? So these indicators going back up and the price is also going up and hit like highs, and then there are some, again, pullbacks. That's when you go to the green zone, and then when you go back above that -1 indicator, you have this bigger move to upside, and it's happened over and over and over and over again, right? We can see that clearly here. So that green zone is basically the undervaluation zone, and like whenever it goes up, we go to this red zone, which is above the standard deviation, above the average, right? So in 2 standard deviation, 3 standard deviation, that's when you are overvalued. Now, the stock can stay in the overvaluation zone for a long time, right? As you could see here, it stayed in the undervaluation zone for a long time. The same way it can stay in the overvaluation zone for a long time and it can still go up. Now, recently, what happened was, during April, we were in the green zone. Like we came out of it April 6th, right? So the price start going up and the P/S ratio start getting closer and closer to its average, right? We can see it right here. It went up, higher, higher, and it keeps going up. Now we're in the red zone. Question: does it mean we're at the top, or are we still gonna go higher? We can backtest this, right? We can see what happened before and get a better idea of what might happen in the future. So we have this custom strategy here, right? So let's take a look. We recently crossed above that 1, basically, which when the price was 250. And if you were to buy at your entry condition was cross up 1, and you would wait 30 days, right? So let's say you bought this at this point of time, April 15, you bought this stock. April 15. Today that I'm recording this video is May 11. So less than a month ago. After 30 days, historically, first of all, this cross above 1 happened 89 times in Amazon history. Okay? Over these 89 times, on average, if you were to buy the stock at that moment and waited for 30 days, on average you would gain 4.89%. Now, it doesn't mean you would win every single time, but on average, you would get that one. There are many, many times that would you lose money after 30 days. So you cannot expect a positive return after 30 days necessarily, because your average is 4.9. The chances that you lose money is around 30%. 11% of the time you would lose up to 5%. 15% of the time you would lose between 5 to 15%. And 5.6% of the time you would lose more than 15%. And the rest of the time there's a chance for gain. And on average it would be 4.9%. If you were to wait, if you bought it recently, right? I'm talking to the people who just bought it recently after this 20%, 30% move upside from the bottom, right? After 30 days, you can expect around 4% return. What about 90 days? After 90 days, you could expect around 14%. 14% return. But you could also expect 25% of the time, almost 25% of the time, of a loss. So there is a 25-30% of chance that in 90 days from now you're still negative. Okay. What about half a year? If you wait half a year, then your average return go up a lot. So 33% on average people would make historically. But still there's a chance to lose, and the chances that you lose now is going lower. So there's around, I would say, 20% chance that you would lose money, and 80% chance that your portfolio will be green, if that's your portfolio, basically all of it. What about 365 days? Let's say you're a long-term investor, or mid to long-term, and you wait for a year. You bought the stock, wait for a year. Now, on average, you could expect 99.7% return, 100% return on your money. However, there is still chance that you would lose. And there's a 10% chance that you would lose big. 10% loss. 10% loss. More than 15% loss. There's a 10% chance that you would lose more than 15%. And overall, there is a 20% chance that you would lose after a year. And 80% chance that you would gain something. Okay? So I'm not going to go over like multiple years now, but I want to show you guys what would have happened if you were a little bit earlier into the market, right? If you, instead of waiting until this indicator hit 1 and then you buy it, like instead of waiting after this big rally and then jump in, what if you catch this move early on? And we saw that in the historically, if you look back, whenever this indicator crosses above -1, that's when you have this run up starting, this massive run starting. I can go back again, the history. So here you have crossing above -1. I know you will have another dip, but eventually you had this bigger run to the upside. So you might catch it here, or you might have catch it here. Both case, you wait until this P/S ratio hit 2 or 1.5, and then you sell. You would gain much more, as you can see here. So here we broke above -1, and we see this massive rally upside, and so on. Like here again, we see that going up. This one is a bit different. Again, we're talking about chances and you want to have highest chance of winning. So in this case, you wait until it goes above -1, but stock doesn't have that much of big of a rally, have another dip, and next time it has this massive move up. Um, so so let's have that -1 as our threshold. If it cross up, so we saw that in this case, if you were to wait 365 days, your gain would have been 99%, and you would still have 20% chance of loss. What about this case? So in this case, if you were to catch this trend early on, your average gain is less, right? On average, you would make 73%. But the chances that you would lose money significantly drops from 20% to almost, I would say 9%. Yeah, to 9%. So you cut the chances of losing money in half and add that to your chances of gaining. And gains above 15% significantly increase. You see 87% chance that you would gain above 15%, whereas in the other case, that chance is only 65%. And that was a year, so you can like experiment with different timeline, different. If you were to wait 180 days, that would be 44% chance of gain. Yeah. So what I wanted to tell you in this video was that there is still room upside. It's still a chance that this Amazon will go higher, as we said, like this can stay in the red zone for a long time, can grind higher. But we definitely, we lost that 30% move up. And from here, the chances that you will be positive in a year from now is less than if you were to buy at lower P/E ratios. I just want you to know, if you have this stock, if you think of buying Amazon, just be aware of that. Be aware that this P/S ratio is now an overvaluation zone, and it can stay in the overvaluation zone for a long time. But in a year from now, there's a 20% chance that your Amazon position would be negative, and 80% chance that will be positive, if history is any indicator. Okay? If you guys like this content, please give this video a thumbs up and subscribe to my channel. And thank